All right, the AI revolution is here. And let's be honest, investors are scrambling to get a piece of the action. But with all the hype, there's this massive puzzle we all need to solve. What is the smartest way to actually invest in AI? Okay, let's really dig into this.
You know, when you cut through all the noise, it really boils down to two main paths you can take. You can try to use AI to outsmart the market itself, or you can invest in the companies that are using AI to outsmart their competition. So the big question is, which one of these is actually working out better?
So let's frame this up. On one side, we've got the AI investor. Think of a super sophisticated system trading stocks and bonds. And on the other side, you've got the AI adopter. These are just regular companies using AI to get faster, leaner, and more efficient. These are two totally different philosophies.
To really get a handle on that first path, we're going to put one of these AI investors right under the microscope. We're going to zoom in on a specific fund that literally handed the keys over to an AI to make all of its trading decisions.
So this is the Kananga Global Multi-Asset Fund. Its whole strategy is to invest in a target fund that's run by a really powerful AI. And that AI's job? To chew through massive amounts of data, price, volume, you name it, spotting patterns that you or I could never see, all in the name of capital appreciation. In other words, to make money.
So, how did this super smart AI actually do? Well, for the last quarter of 2025, it came back with a negative 5.47% return. Yikes. That is not exactly what you'd expect, right? It fell way short of its own benchmark, which just raises this really interesting question.
I mean, if you have a sophisticated AI that's built from the ground up to find profitable patterns, what could possibly make it fail so badly? Was it a bug in the code? One bad call? Or was it something else entirely?
Well, the answer is hiding in plain sight right here on this chart. The problem wasn't a single bad trade. It was the entire economic environment. This chart shows the volatility of the Federal Reserve's interest rates. And just look at that huge spike on the far right. The fund manager called this a 3 sigma event, which is just a fancy way of saying it's something so rare it should only happen about once every 28 years.
And here it is, the smoking gun, straight from the fund manager's mouth. They said that the absolute worst-case scenario for their AI is exactly what happened. Crazy, spiking interest rate volatility that was being caused by rising rates. See, the AI is amazing at spotting long, predictable trends, but this kind of sudden economic shock, it just completely shatters its models. It's like it's kryptonite.
So here's the crucial takeaway from this deep dive. The AI stock picker strategy, it can be incredibly powerful, for sure, but it has a massive Achilles heel. It's a specialist that is hypersensitive to these big, out-of-the-blue economic shocks, and that's a huge risk you have to think about.
Okay, so that was the microscope view on one particular fund. Now let's switch gears. Let's pull back and take a telescope view of the entire market to see how those AI adopters are getting on.
And for this, we're looking at a huge piece of research from Morgan Stanley. I mean, their team mapped out AI's impact across 3,600 stocks all over the world to figure out where the real return on investment is actually showing up. And they focused heavily on this group they call AI adopters. Now again, just to be super clear, these are not the companies building the AI chips or the software. These are the companies using that tech to get a real advantage in their own industries, whatever they might be. Now, this is where it gets really fascinating. Look at the clear separation on this chart. Since late 2023, Wall Street analysts have been upgrading their profit forecast for these AI adopters at double the rate of companies being disrupted by AI. The market is clearly sending a signal. It's rewarding the companies that are actually putting AI to work.
But how? How exactly are these companies creating all that value? Are they inventing some kind of amazing new AI product? Well, the answer is actually way more practical, and it's a real eye-opener.
Just look at this breakdown. According to Morgan Stanley, a staggering 89% of all the benefits these AI adopters are seeing, it comes from cost efficiency. Only 11% comes from generating new revenue. So the big win isn't about the top line, it's all about the bottom line. It's about using AI to do more with less. And you can see the result of that efficiency right here. That intense focus on cost savings translates directly into bigger profits. Between 2024 and 2025, these AI adopters grew their profit margins by 3.1 percentage points. That is more than double the margin growth for the average global company. They are just becoming fundamentally more profitable businesses.
So we've looked through the microscope, we've looked through the telescope. Let's put these two very different paths right next to each other and see how they stack up.
So, on one hand, you've got the AI investor. The main goal? Beat the market. The source of returns? Super sophisticated pattern recognition. But, as we saw, the key risk is that massive economic volatility just shatters those patterns. Then on the other hand, you've got the AI adopter. Their main goal is simply operational efficiency. Their returns come from saving money. And their risk? Well, it's just failing to actually execute on their AI strategy.
And that leaves us with one final fascinating question to think about. As AI just keeps getting smarter and smarter, who are the real long-term winners going to be? Is it going to be the giants who build it, the high-tech funds who trade with it, or is it going to be all those everyday companies who quietly and effectively just put it to work?